Hello, hello. A quick announcement. For the next hour and a half or so, there will be a lot of young startup companies giving their company overviews and pitches in the varsity room, one after another. They're very quick, but something worth stopping by, not to take away from this panel. They'll be going on long after their panel is concluded, but we're making this announcement to every room. Stay here, you have great guests, but we want to have some awareness for some of the really young entrepreneurial people who've shown up to pitch their company and just get some visibility and awareness. So just a heads up there. Hope to see you in the varsity at some point this afternoon.
Yeah, thank you all so much for coming. We're going to get this started. We have a very exciting panel for y'all today. Show me the money, financing the stars of tomorrow. On that note, I'm going to hand it over.
Here she comes.
All right, good afternoon, everybody. We'll wait for Carol to get up here. Okay, I'm proud to moderate this panel this afternoon on Show Me the Money, which is a great name, right? I may be a little nervous. It's not just because they told me not to wear a tie today, which is different for me, but because I definitely bring the average down with this panel. It's a great panel. We're going to try to keep this as interactive as possible. So if somebody has a question, even while we're talking, raise your hand. I'll try to get to you. If we don't, we'll get to you afterwards. We'll probably leave 10 minutes or so for questions. Before we jump in, I just want to introduce each of the panelists, and they'll say a little bit about themselves. We have Carol Foster, John Jamison, who I've worked with before, and David Spreng. And each of them is going to say a little bit about themselves. I'm Mark Solomon. I'm the managing partner of Katten, Roseman here in Dallas, and I'm a private equity and M&A lawyer. Before I turn it over for each of them to say a little bit, David may not want to mention this himself, but David has a book coming out on All Money Is Not Created Equal. It's going to be published this summer by John Wiley & Sons, but what a great title and what a great book for this topic. So with that, maybe David, you go first on the intros, and we'll take it from there.
Sure, thanks very much. And you can pre-order the book on Amazon. So my name is David Spreng. I'm the founder and CEO of Runway Growth Capital. We're based in Silicon Valley with offices in New York, Chicago, San Diego, Boston, and Dallas. And we're a little different than a lot of the other investors that you come across in that we don't invest equity. My background for many, many years was as a venture capitalist, and that was buying shares of companies by investing equity. What we do at Runway is make loans as an alternative to an equity investment, the biggest benefit of which is that if you take out a loan, you're not issuing any shares, so you're not diluting your ownership and the ownership of your earlier investors. We write checks between $10 and $100 million, generally for very late stage venture-backed companies that are on a path to profitability. And on average, our companies have raised already over 100 million of equity. So they've given away or sold a lot of their company already. And they're on this, like I said, path to profitability or path to an exit. And why not use debt at that point? And for many years, debt was viewed as something that was inappropriate for a pre-profit company. And over the last decade or so, it's become, I guess, conventional wisdom and well understood that debt is appropriate, proper, prudent, and even wise, especially for later stage companies.
I'm Carol Foster. I'm currently the COO of a company called Bellevue Associates. I joined them 6 weeks ago with a friend of mine who I worked with at Merrill Lynch long ago. And we work with small to mid-sized businesses to help them become employee-owned. I have a 35-year career in finance, financial services in particular, and spent the first half of my career as an investment banker at Goldman Sachs and Merrill Lynch, and then the second half as a CFO of various different businesses, one of which is Michael Moe was on the board of, GSV was an investor. And that company helped employees of private companies sell their stock.
John?
Yeah, my name is John Jamison. I'm a director at TD Cowen. TD recently acquired Cowen in late March. I run the healthcare services team there and primarily focus on provider services, HCIT, and tech-enabled services. I've got a 15-year career in healthcare investment banking. We've touched everything from very early stage healthcare companies and tech-enabled service companies to calling on and banking corporations. So excited to be here.
I forgot to mention one very important thing. I'm the proud mother of a Tufts men's lacrosse player, and they're playing in the national championship on Sunday. Roll bones.
All right.
Generating the positivity towards the team.
Who are they playing? Who are they playing?
They're playing Salisbury. Yeah.
I got money on Tufts. So let's talk a little bit about, David, you're talking about debt. You know, in ESG investing, mission investing, why is debt appropriate? Why would you be thinking about debt for these companies? Tell us more.
Well, I think debt is appropriate for every company to consider. It's not always the right answer. You know, debt is really for companies that are predictable and confident in their ability to repay it. Debt is a lever, that's why it's called leverage, and there's a lot of benefits that come from that, but there's also negatives if that leverage goes in the wrong direction. So I wouldn't advocate debt for a very early stage company, and I wouldn't advocate debt for a company that is purely dependent on charitable donations, for example. You know, I've been on the board of a lot of nonprofit companies, and most of them will utilize a line of credit to get them through seasonal cash flow issues, but I wouldn't suggest that you go out and take a super big loan and the only way you can repay it is through contributions. But this conference is about companies that have a double or triple bottom line, where they are both purpose-driven and profitable, and at a stage, a certain stage, when you're mature enough and predictable enough and confident enough, debt can play a role.
Yeah, I think I'll add on to that. I mean, I think that David said it really well. Debt can be a leverage to really enhance growth. But as we think about impact investing and ESG investing, like there becomes a point, right, where that company becomes legitimate. And typically that's a cycle. The first is like the core ESG investors, your angel investors that really believe in the theme. The second is like a crossover, you know, a blend between VC debt and those core investors. And then the third is something a little more conventional. And that's like a more robust VC team or conventional private equity firm. And I think at different stages along that cycle, debt is used as a mechanism to achieve targeted returns or juice returns. And so depending on where the life cycle is of that company and its growth plan, I think debt can be used along the way to help accelerate growth there. Makes sense.
And so there's a difference then between late stage and early stage companies in your guys' mind?
There is, but I think one of the points that David was making was more important, which is you've got to examine all your sources of capital and figure out which one's best for you at which point. And, you know, basically you could call somebody like John or David, and they would come talk to your company, explain to you, and you can talk to multiple people, and you can develop your own opinion over that. But you'll pay, you know, by having these conversations and examining this, you can figure out the least expensive cost of capital and also the best for your company at that stage.
And so where does equity fit in then? We were talking about debt, how it's appropriate. What about equity?
Well, I think equity is the base. That's your first money. So, you know, very often your first money is friends and family and your own personal credit card. And then once you've developed a business that has some notion of repeatability, hopefully positive gross margins, and, you know, a minimum viable product, then you can start to raise outside equity. And there's kind of a progression that is very often the case, where maybe there's angel investors, then there's seed stage investors, and then you can start moving into the regular progression of Series A, B, C, and on from there.
But how does all this play into the Mission Summit? How do you think about this financing in general in terms of the Mission Summit?
Well, I'll go, and then, for me, I'm just hopeful that someday soon, mission doesn't have to have its own category. That just every good company has a mission, and it's a prerequisite for any kind of funding. And a lot of the stuff that we see is businesses that have a very strong value proposition and a mission-driven management team that are doing it to improve the state of the world, and that they surround themselves with other people that see that value, and that will also drive revenues and ultimately profitability. And so they're not mutually exclusive. I think I hope the days of going into investors and saying, we've got a great company, we've got a great idea, but we're not going to generate market returns because we're mission focused. That is difficult, and I hope that with this and other venues like it, we step beyond that.
I think we have. Certainly in the private equity and venture world, some of the most important research folks that study those firms now look at impact investing as not putting the mission above the financial returns, but rather considering them both as most important. What is your mission objective? What's your financial objective? And both of those have to be met.
Yeah, I think that's right. I mean, like the saying always goes, it takes 10 years to get a 10-year track record of returns, right? And I think we've been talking about mission-driven investments, ESG, and impact investing, now for 10 plus years. And I think that the notion was that in a downturn, people will be not willing to invest in mission-driven enterprises or companies. And the fact is I think during those downturns, like the COVID pandemic, there were areas of opportunities that were identified that helped accelerate the focus on mission-driven companies. And with that, charitable donations increased, the government stepped in through the CARES Act, institutional investors that were mission-focused or mission-driven poured capital into these types of companies. And as a result of that, helped accelerate this focus and this drive towards investing in companies that not only perform, but also have real results and have demonstrated evidence-based results across all subsectors. And I think you really see that in your everyday life now in terms of what are the three biggest categories, right? Like climate change, financial services, and healthcare. And I think that you're starting to see that impact across those three subsectors, on your everyday life.
And, in that regard, when you talk about mission investing, are the returns that investors get in mission investing, are they the same? Are they different than companies that wouldn't qualify? Or what do you guys think? We talked about this a lot before.
We did. This is one of the things I actually spent time on after we had the conversation, because we were like, okay, well, can we prove that impact companies are earning returns that are similar to everybody else? And I did a lot of research on it. There's some organizations out there that study this, and McKinsey did a pretty interesting report. And the point is that people who do impact investing, they're the same as investors that invest in all kinds of businesses. And so some of the investors that make those investments do incredibly well, outperform the S&P 500, and some of them don't. So I think what you can expect is, back to what I said before, you can expect financial returns and a company to have a mission that satisfies your investment needs the same as you would make an investment anywhere else.
I would just put an asterisk on that, in that I think that the studies that show that mission-based investing is every bit as good or maybe better are focused on public market investments, where you've been able to do back testing.
That's fair.
Yeah, and,
That's fair.
And I think the jury's still out on the private side. There's been a lot of money flowing into private, mission-based, impact, sustainable, whatever you want to call it, and probably too early to tell on that, unless you've seen something else.
I think that there's been an increase in activity on the private equity side that has been led by large mega buyout firms like KKR,
TPG.
Bain Double Impact. Now, they've leveraged their expertise in particular subsectors. You mentioned TPG. TPG has done a great job of really diving into healthcare and focusing on it. You know, I think that for those types of companies and those types of investments, size matters, hold period matters, and the measuring results matter in terms of being able to track how the investment is, and then allowing the private equity firm to come in with their toolkit and establish their value creation playbook. So establishing scale, attracting talent, et cetera. But I think with those professional investors and those investments in mission-driven companies, they are yielding, you know, impressive returns, but it's with the expertise that that firm brings. You know, like
But that's always true.
Oh, of course it is.
That is always true. I mean, I guess the thing that I would say is I see more companies that are being founded that have a mission as their purpose. So I'm on a board of a company called Veriscore. And the concept behind Veriscore is that credit scores don't really help a lot of the population. They help people who don't really need money, basically. And what Veriscore is attempting to do is to go back and measure how to figure out how to measure, you know, somebody's ability and willingness to pay back. So looking at, do you pay your cell phone bills, and looking at your paying apartment rent, which is never measured in a regular credit score. And what I would say is the company's really, really early. We have our first customer, but there's a ton of interest in it, and I believe it's going to be a huge market. Now, whether or not Veriscore is the one that capitalizes on it, I don't know. But for example, we now have the attention of the Texas Department of Housing and Community Affairs. The chair of the board will be here tomorrow speaking about the future of housing. And they are taking a look at it because what they're trying to do is to make sure that their constituents can qualify for housing, and looking at Veriscore to help them do that. So I think that there are big shifts in markets that are taking place with mission-driven corporations that you can already see how big the market is, and hopefully some of those will be able to prove as successful as other investments.
Yeah, like that is a great example of a company that should get mission-driven growth capital. And I don't want to be the Debbie Downer in the room, but I think that we have to be honest about some of these things. And, you know, the efforts that are happening from large PE platforms, and I hope there's nobody from TPG or BlackRock in the room, but, you know, the amount of money that they've raised under the guise of impact investing so that they can please their pension fund and large endowment investors is massive. And I would just say, look at those funds and look at the companies like TPG Rise. I think every one of the companies in there would have been funded anyway, whether it was called impact or not. But it enabled the big fund to say to their constituents, we've made a big investment into impact. And I think that's almost by definition greenwashing. And that's kind of what I'm nervous about. You know, it is getting money to flow, and the results are good, but I'm not sure it's really moving the needle on the mission.
Yeah.
So
Well, I agree with that. And maybe to play banker here on this stage. I do think that having thought leadership from both ends of the spectrum, whether it's VC debt, VC capital, or more traditional large cap buyout like KKR, Bain, TPG, is healthy for the conversation. And maybe, you know, it's it's kind of the same saying that, you know, you talk early and you talk frequently about it. If conversations in the boardroom around mission-driven enterprises or governance or, you know, impact investing, and those conversations are starting very early in IC in the board meeting, effectively you're de-risking by the nature of those conversations, those investments. So, I mean, I think that the market needs both. It needs entrepreneurial, disruptive investors to help be a lifeline for these companies that are out there trying to shift markets. And then it needs validation from, you know, the other end of the spectrum, or the other end of the market. But yeah, I think you're right. I mean, they probably would have gotten an investment because a banker like TD Cowen probably would have taken it out, and they probably would have got financing. But I mean, that's the reality.
Yep. Well, I think the other I agree with you. The other interesting angle that you're seeing is folks saying, we're going to be more effective creating change by being on the inside, so we're going to go buy shares of Chevron. And, you know, and that's impact investing because we can advocate for change.
And that's what happened at
We
Exxon.
did see that at Exxon. Yes, absolutely.
Yeah, I think that part of it's fascinating. There's so many different ways to look at impact investing, and I think what a lot of public companies did was they latched onto this concept of ESG, environmental, social, and governance related issues. Well, the thing that's funny about that is now the SEC is like, great, you claim this, show me how you're measuring it and prove to me, you know, what that is. And so there are now reporting requirements that are coming out saying, okay, I need to know how you are measuring your impact on the environment and how you audit that so that I know that what you're putting out there is real. So there's so many different ways that this is sort of triangulating and coming together, both on the public and the private side.
Well, it's got to be very difficult because people have been talking about the biggest hurdle between us and finding the real solution is measurement. And they've been talking about it for 20 years. And they still haven't figured it out. So this must be difficult.
And some of this stuff, as we were talking before, they almost have to backfill the data because who knew what ESG was 20 years ago, right? There was no defined term. What about taking a step back? We talked about greenwashing. You're investing in a company that's, and your purpose is, you know, mission investing. How closely do you look at management? What's the role of management? What do they have to show you? We can say a company, this is what we do, but what about management themselves?
I'll go very quickly. I think it's literally everything because the tone of the company, the mission of the company is set from the top. And you have to do more than talk the talk. You've got to walk the walk. And we were talking in an earlier panel about how young people care far more today about meaning in their life than they do how much they're making at their job. And if you think you're going to get away with being a CEO of a purpose-driven company and not walking the walk, you will fail. They will see right through you in an instant, and they'll be gone. So I think senior management, it may not be everything, but it's an absolute prerequisite. Without it, you will not succeed.
I think from a banking perspective, like financing companies throughout any stage always comes down to a couple of brass tacks. And management team is always number one or number two. And along every stage of every company, there's a point where you have to have a salesperson and a leader in order to get everybody inside your company to adopt the culture and adopt the mission. And without that leadership team or that leader, then it's nearly impossible to professionalize a business, to convince somebody to lend you money, or to execute on a growth plan. I think that it starts at the top, and if it's not the top number one thing, it's got to be the top three.
And aside, so we have management, obviously the stated purpose of the company, we have B2B. What else would there be that you would look at that you'd say, hey, this is important to us, or would be something that would be disqualifying when you're looking at a company that's supposed to be, if you're investing in mission-driven companies?
Cash flow.
Cash flow.
Yeah, I mean, so, well,
We just
so-
get back right to it, don't we?
Well, you know, and it's a matter of perspective. Every company that we invest in at the time of the investment is negative cash flow. That's just the world. That's the little barrier that protects us from all the other lenders out there, because nobody understands how to or likes to lend to pre-profit companies. But I think in the traditional financial world and analyzing companies, yeah, happiness is positive cash flow. So things that would be disqualifiers would be a management team that's perceived not to be honest or trustworthy. You know, it's shocking how many companies like literally have negative gross margins. You know, every dollar they sell, they lose more money. So that's obviously a disqualifier. And, you know, but for us, we don't need to have a Facebook to do well financially. So, you know, we want companies that are changing the world, but it doesn't have to change all of it. You know, impact a community, impact one niche, but be able to build a viable long-term business. And I would add the other thing that kind of bridges between us is, you know, we need a path to profitability. That, you know, you might not be there now, but you can see how you're going to get there. You know, the days of just throwing money after revenue growth that's not going anywhere, those days ended with WeWork.
Fair.
They ended everywhere.
Maybe to jump in, I think like if we, you know, I think it's important, really depending on the context of the macro environment, if we like rewind the tape back to like pre-2020, you know, I think that the markets are roaring, debt is cheap, companies are out there and they're shifting markets. Like life science is a good example of this. There's a thematic investment thesis there that investors can latch onto. These companies at the time, not cash flow positive, they're burning through R&D, they're trying to bridge a gap in clinical trials, but you know, they have a path towards commercialization. And so, you know, the reason why I brought this up is I think cash flow is important, but it's not everything. And having a management team or a path towards, you know, commercialization, you know, partners along the way that are going to facilitate that are important. I think they're increasingly important in this macro environment than they were maybe 2.5 years ago. But, you know, everything is cyclical in this industry. And so I just wanted to put an asterisk.
If you take a look at the companies that you're seeing now who seek your services on the healthcare side, how many of them would you say strike you as companies with a mission? You know, they're going out there to solve some significant problem for a part of the population. And what would those problems be that you see that they're trying to solve?
Yeah, no, I think it's great. I think most either operators, investors, or bankers in healthcare have always adopted the philosophy of doing well and doing good. There's this notion of trying to improve a mission related to improving the delivery of care, improving patient experience, and reducing that cost of care. So I think that majority of the companies that we work with, or we, you know, like to advise, on the surface level have that moniker of we're trying to improve healthcare, right? I think if there is a subset of that are actually trying to change the world.
Yeah.
And I think it's easy to say like life science therapeutic businesses that are really trying to eliminate or reduce certain cancers, like those guys, those scientists are really, you know, something special. That's very different than, you know, a group of med spa or plastic surgeons that are trying to consolidate the industry and get a, you know, a 5x bagger return on it. Like that's, you know, that's great, but that's, you know, that's serving a different subsector.
Or the new fitness tracker.
Or the new fitness tracker, yeah. I mean, I like remote patient monitoring for different reasons, but
Yeah,
yes,
yeah.
You're changing somebody's world, but not the world.
Yeah,
Yeah,
exactly.
exactly.
Yeah, exactly.
So,
Yeah.
sure.
How about Mark Cuban?
So Mark Cuban, you're talking about the,
Cost plus.
Drug.
And he's cutting down the slashing the cost of medication from $4.05 or whatever. And he's like disintermediating the distribution of drugs.
so I'm a big fan of both Mark Cuban and his company. I think the idea has been around for a long time. And it accelerated after it became obvious that the United States didn't have the manufacturing facilities onshore, right? We are in a position where a lot of our manufacturing of essential medicines are being made in the Philippines or, abroad. And so there were companies that emerged out of the CARE Act that started looking at this space to repatriotize the manufacturing of these essential medicines and reducing that cost. Mark Cuban has done a great job of accelerating that path towards commercialization. There are other companies that are out there that are trying to do it too. Flow is a good example of that. It's been all over the journal over the last couple of months. They're actually building facilities in Virginia and Washington, D.C. I think that this is good, not only for the patient, the end market, but I also think it's important to create like low-cost drugs and healthcare for everybody, but also increases competition in the private sector. There's no reason why these massive pharmaceutical companies need to have a monopoly. So, if Mark was here, I would love to pick his brain about that. Candidly, Flow is a client of mine, and we're raising $100 million for that company as well. So
it's a mission.
It's a very much a mission-driven enterprise. Yes.
Yeah. So GoodRx is another example of that. And they didn't come out and say they had a mission and a whatever. You just can get your drugs for less money if you use their app. Full stop.
Full stop.
Yep.
It sort of dovetails with, one of the questions we were talking about before is, what industries have been most affected by mission investing, socially conscious investing, ESG, and healthcare is certainly one of them, right?
Yeah, I would say that, I think we named the top three, right? It's environment, thank you. Financial services, this idea of microfinancing has become very popular in the last couple of years. I wish that they would gain more traction in the United States. And then healthcare. And I think as you think about healthcare, it's improving the delivery model. It's improving patient engagement and access to care. Behavioral health has become increasingly popular over the last 24 months. And then, how do you treat an aging population and make, a generation of this country become more comfortable in the late stage of their life? And, I think across all of that, there are different business models that are focusing on how to improve healthcare that are really, truly mission-driven. Now, that subsector is very different than life sciences that are actually trying to change the world, change the DNA and whatever else preventative diseases that we have. But I think that healthcare is quickly climbed up the adoption curve and towards a mission-driven. And I think over the next 5 years, we're going to increasingly see more and more disruptors in this space.
So Carol brought up the point of GoodRx, which branded differently would be considered mission-driven, but as branded now.
Exactly. Yeah.
As capital allocators, how do you think you and then your industry more broadly are and should be thinking about the difference between GoodRx as a mission organization and GoodRx as it is today? Is it just another way that a company differentiates? Is it fundamentally different? What are your thoughts in that area?
Go
I
ahead.
guess this is one of the things I find interesting. It's like the power of language, right? I'm a finance person from day one through whatever till the day I'm not here anymore. But their words are so intensely powerful. And what we keep doing is we keep changing how we talk about things. This came up in one of the, is it ESG that we care about? Is it D&I? Is it impact investing? What is it that we're exactly talking about? And I guess the thing that I like about GoodRx is they have this great business model that helps everybody who's a customer of theirs just because that's what they decided to do, right? And so you can find like all different kinds of ways of looking at that. So this business I joined about 6 weeks ago that does ESOPs. So my partner passionately believes in putting equity in the hands of the employees who work for companies. Passionately believes in it. And so that's another way where, is it a mission-driven company? Oh, heck no. But does it accomplish a really great thing? I think so. that's why I work there. So I think, and this is to take a little bit of a personal turn, I used to think of my world as, okay, I'm gonna do the thing where I work during the day, and I'm a finance professional, I'm gonna make a lot of money, so that I can then turn around and put it in the things I care about, which is economic equality, access to education for everybody. So I fund financially needs scholarships, and I work on the board of Oakland Lacrosse, where we provide a home base for a bunch of kids in Oakland. But I've figured out through time, and then through this too, that I can have it all in one place. So it's how companies think of themselves and how they see themselves, and how we as individuals view ourselves and what our life's work will be. My life's work is finance, but guess what? I get to help a bunch of people who would never have access to equity in a company get access. And I think Michael said this in one of the panels I've listened to so far. You can't really make a lot of money just with salary. So the fact that we're actually giving people equity and giving them the opportunity to step up through that ownership is important.
My perspective, wearing my capital allocator hat, is I don't care. I am looking for the best company I can possibly find and get behind those people. But I can tell you, increasingly, they are mission driven, and they may not brand themselves that way,
Exactly.
but I don't know that it matters. So we're making sure that the money gets in the hands of the companies that are doing important things. And sometimes some companies just don't want to go down that road. I don't know why GoodRx doesn't brand itself that way, because you would think it'd be pretty easy. But there was a time where you did not want to raise money under the impact banner, because it would make it more difficult to raise from traditional venture sources later. That's over, but there was a time. So that might have been a factor for a while, but just the pure capital allocator hat, and keep in mind, where we sit, one step removed from the companies, then we've got our own investors, and then they've got their own constituents. So everybody's got a different point of view.
I think there's like, if you rewind the tape, like 6-7 years ago, there were two different investors. There were investors that were totally focused on, I have an investment hurdle and this is what I have to do, right? And I just want to find the best company. I don't care what it is, right? And then there's another set of investors that said, okay, this is mission driven. I love the DNA of this company. I'm willing to take less of a return hurdle in order to make an investment, social impacting. We needed that, right? We needed that as a society. Now, hopefully, we're at a point where we're starting to see more of those opportunities that you don't have to decide, am I going to put my capital here versus there? Ultimately, at the end of the day, at least in healthcare, a lot of those companies have the guys or have that mission statement that's saying, look, we're going to make an impact. It's measurable what that impact is, and we can track it. And we're also going to have the investment results. And I think that's like what GoodRx is doing. And I think there are other companies out there too that are giving real thought to measuring the efficacy and the impact of what they're doing, and what is that social impact. And if they're doing that while generating returns, then they're superstars, right?
So just one other comment, which is it's another way of looking at it from the other side. I'm really involved with a seed stage venture firm in Silicon Valley that pretty much will only invest in companies that are run by women and minorities. And so you'd say, oh, well, that's huge, mission-driven, impact investing. They're adamant. No, it is 100%, because that is where we're going to make the most money. This is an entrepreneurial pool that's underserved. They outperform, and if we can own that category, we are going to outperform. And so far, they are.
Which firm is it?
It's called ULU. ULU, which is a Hawaiian word. I don't know what it means. And it's a husband and wife team out of Stanford, and I don't know how many investments they've made so far, like 40, and half of them are unicorns, and they made them all at seed stage. So it's pretty impressive.
There's another,
sorry.
yeah, go ahead.
I'm sorry. I mean, is the fact that we're talking about this now, is it a function of our own market and our own journey as the U.S.? How would this be across markets and across different journeys?
So I worked for a large fund-of-fund business many years ago that was based in the UK. And European investors were far more advanced in looking for the social impact of the investments that we made than the US. US hasn't caught up with that yet, but they were very focused on climate. And so I would say we're playing catch-up a little bit.
So there's a space and a time element to
Yeah.
this.
That's right. That's right.
Well, you have to also remember, legally, up to 15 years ago, there was a big question whether or not a board could consider something else other than profit and loss. I mean, your job is to maximize value for shareholders. How does this fit in? And it's been a process, and now what we're seeing is more and more of the time it does fit in.
Well, it's still a debate.
Yes.
Can you consider stakeholders, which includes the community and the people who work for you? Or do you have to focus on shareholders, right? I mean, that's still a debate. That's part of why Michael Carter and Michael Moe came up with Mission Corp. It's so that it's very clear to everybody what your mission is. And for current C Corps, you know, the push is on the ESG part and being able to report on that, but they're not quite to a point where they can claim that they can cover stakeholders and not just shareholders.
Yeah, I agree. Europe is way ahead, has been and still is. I don't know about the rest of the world, but
I
I'd
don't
say
know
we're
about that
probably
either.
in second place.
You know, talking about, mission-driven investing, we talked about healthcare. John, what about mental health, wellness, things of that sort?
Yeah, I mean, I think that in any industry, if there's inequality, I think that there's an opportunity for these mission-driven companies to come in. I mean, I think that when ESG splashed onto the page, there was a tremendous amount of focus around the sustainability portion of that. And then governance became an issue. And then, how do we start to think about mission-driven that encompasses kind of all three in the Venn diagram? And, right now, I think in healthcare, I think that they're coming out of COVID, there has been a real acceleration around providing low cost of care and high quality care, and that encompasses both life sciences, but also on the other end of the spectrum, mental health. And I think that the CARES Act plus mission-driven companies and thought leaders have said, look, how is there a way to approach mental health with technology to provide care to individuals, with certain needs? And that's when all of a sudden the CMS and the CARES Act provided reimbursement for HCIT companies and telehealth companies so you can get, on-demand care. Well, these ideas aren't foreign, like to your question. Europe was looking at these options, years ago. It didn't take the pandemic to introduce this idea, right? So I think other geographies had been experimenting with this, but coming out of COVID, there was kind of this notion inside of healthcare of like, look, there are real problems that we have, and there are real opportunities to fix things through a real strong mission. And I think, to Mark's point, behavioral health is very much in that red hot center, very similar to like therapeutics and life sciences, because you're providing care to people at a low cost in the safety of their home without going to see a doctor, et cetera. And that, I think that latches on, that resonates with everybody in this room.
We talked a little bit about how things have, I'm sorry, go ahead. I missed you.
So are the VCs and PEGs still giving companies a valuation haircut for having a B Corp designation?
Good question.
That's a really good question. I don't know.
I don't know the answer to that either.
It depends on their history of demonstrating, right? So B Corp, you have to demonstrate in how you're measuring it over time. And I think that if a company is it's all about track record. I think that in most cases, investors won't say that there's a discount or a haircut to it, but there's a soft discount to it. That's the reality of it.
And why is that? Is it because the constant measuring if you want to maintain status, or what would the reason
Yeah, I
be?
think it's that.
I mean, it's an issue I
There's
find
a risk
people with that.
embedded in
Right.
with that reporting and that measurement. And, you know, I think that in all these, the thing that we're not talking about in this room is capital risk and execution risk and, you know, exit risk and, you know, liquidity is associated with that, with those risks. And, you know, that's something that, you know, that's the underbelly of mission-driven companies, is how do you underwrite that risk? And, you know, B Corp corporations, you know, if they're doing a good job, they shouldn't get a discount. Realistically, they probably are. But you know.
Okay, but there's an underbelly to that underbelly also, which is the subjective.
This is getting fun.
Which is the subjective portions of that,
Of
you
course.
know?
Yeah, well.
Yeah.
I mean, we're talking about mission-driven, though.
Yeah, but
Yeah.
the truth is, when two companies come into your office and one is a B Corp and the other isn't, then you just look at the B Corp as being an impact-driven company. They obviously thought a lot about it and chose to be a B Corp. And whether we like it or not, there's still a perception that they're willing to give up some economic gain for social impact. And that's probably great, and it may not even be true. And it's probably true that the more socially oriented company will end up having the better results. But we're still coming out of an environment where VCs in particular don't view it that way.
Well, the thing I find short-sighted about that is we've talked about how folks who are graduating from college today care about meaning in the work that they're going to do. So if you want to hire people, you be authentic, you put out there what your company's going to do, and you hope that you attract the like-minded people. And by attracting the like-minded people, maybe you cut down on turnover. So you have much higher retention. So it costs you less to get your most precious asset, which is your employees.
Totally agree,
so
but
many
if
ways to
you
look at it.
graduate today and go work at Sequoia Capital, you are not going to be making investment decisions for 20 years.
That's
So,
fair.
yeah.
That's fair. That's fair.
But the customer base of these companies is also incredibly loyal, right? And that's a factor in any investment.
Yep.
You know, we
That's fair. Patagonia.
Yeah.
so we talked a little bit about how things are. In my world, things have really changed a lot in the last 6 months. Silicon Valley Bank, how has it changed as you guys look at investments in mission-driven companies?
Dave and I had an interesting discussion about this earlier.
Yeah, go ahead.
So basically, Silicon Valley was banking a level of companies based on a portfolio theory that shouldn't have been banked, right? So they would say, the VC is my customer, even though the people I'm actually lending to are these companies over here. And some of those companies they lent to should have received loans, and some of them shouldn't. And so what I was telling David was I'm waiting for which companies are going to fail because of that. Because nobody else is going to be able to lend to, and you were telling me the number of companies?
Yeah, it's over 800. It could be 1,000 just at SVB, and I don't want to say bloodbath, but I think there is going to be some real trauma in this early stage market, and I think the whole category of what SVB used to do, you know, call it $1 to $5 million loan to a company based purely on who the sponsor is.
Yep.
I think that's just going to go away. And the bumps in the road that we're going to experience as that happens is going to lead to some negative publicity and some company failures. And it's happening at the worst possible time in that we're at the end of a venture cycle, which is very natural. And there's a natural culling of the herd. There's too many companies. VCs always do this. They start 10 companies when the world only needs 2. And so you'll start to see some of them merge together and others fail. And having the bank now wanting their money back will just exacerbate that and make it more and more difficult. And we've only got 5 minutes left, so I'm just going to add one more point, that it's not just SVB and Signature that have already gone under, but the other venture-oriented banks like Bridge Bank and PacWest and Comerica, are getting pressure from regulators and their own shareholders to do something with these portfolios. And it's unfortunate because it was not the venture portfolio that caused the problems at SVB or Signature Bank. It had nothing to do with it.
No, it was the depositors.
Yep.
Yeah, I guess my hope is that it changes some of the clubbiness of the venture world out in California in particular. Some of that's changed because so much of the investment has moved away from California to other states, not away. The money is still there. The money's bigger than it was before, but it's now not 100% in California.
Sure.
It's a big old chunk in Texas and a big old chunk in New York, and then other places as well. And so by sort of breaking up that ridiculousness of UVC will loan to anything that you do, because we're going to, even though we don't have a legal agreement with you, we're going to count on you to pay us back.
Yep.
It's that part of it that I think
Yeah, agreed.
is hopefully breaking and makes for real opportunities for other people.
Well, also, like on the company side, it creates this flight to quality. So the companies that maybe shouldn't have received a loan or backing, or like look at the SPAC market. Like there are very few performers that have come out of the 2020 SPAC market. But
Sadly, you're correct.
sadly, right. But I do think that there's a real flight to quality related to the companies that did fail and others that have capitalized on the opportunity related to that.
Sold.
So,
So Michael Sorrell in the keynote said to dream bigger, and I want to ask you guys to dream bigger. If we want mission, purpose-oriented companies to become the norm, not only in the early stage, but also in the public markets, what rules need to change? How does the overall ecosystem need to change in much more dramatic ways?
Mindset.
measurement.
Fair.
I love that speed round.
Well, it's,
What's your
you know,
import?
I mean, one of the things that we talked about earlier was just the legal standards for a board and what they're obligated to do. Now, they can consider other interests now, but if there was more of a legislative change where the business judgment rule and the fiduciary duties were meant to encompass a greater good aside from, that would be very helpful. It would give boards cover, and I think that would be helpful too.
Is there a group that's lobbying for that change?
I'd be shocked if there's not, but something equivalent to the prudent man rule, where it is legally appropriate and not just you're warned that you're breaching your fiduciary duty if you do it.
And it's moving. I mean, case law is moving in that direction, but it's not all the way there yet. And also, it depends on where a company is in this process. If a company gets to a point that there is no option other than a sale, anything other than the maximization of shareholder value goes out the window. That is all you look for. So it depends on where the company is, and also but it's moving that way, but we're not there yet.
I think your question is a very, very important one, and I think we've all answered it from a different size of company perspective, because Mark is clearly talking about public companies, what the obligations are there, and
It's all companies, all corporations, public, private, otherwise. Those are the fiduciary duties all run through it.
yeah. But what I'm saying is, if you start at the beginning and you clarify, like this import concept,
That helps.
what you're doing and how you're working, how you expect to make money, how you expect to take mission into consideration, your investors are on board with that, VCs get on board with that. It's top down, so addressing the issues that Mark is talking about, and bottoms up as well.
Yes.
I'll address this to David. Years ago, I was a bank many years ago. And the old principle of, a investment grade rated company, you call it prime. What type of pricing do you apply? Prime?
Yeah, so it's a great question. So we would typically be, if you want to reference it to prime, 500 basis points over prime. Yep. And we have a model that we produce very precise pricing. We know the risk we're taking. It just kind of tends to be around that. We also get a little sliver of warrants so that we get some equity upside. Yeah.
I think that's all the time.
We're getting cut off. Mark, thank you.
Well, great. Thank you, everybody.
Thank you.
And this is this will not cannibalize David Spreng's book, which I do encourage everybody to pre-order. But one of my close friends has a book called The Good Your Money Can Do, and I have 4 copies here. If anybody wants it, she has a fund called Beyond Capital, and it's really great. Thank you.